the National Marketing Director. And today we're having a great call. Our guest speaker is Mike Matlock, Regional Sales Vice President with MetLife. And he's going to be talking about short pay durations and some great sales ideas that he's used recently to help close some large cases. So with that, Mike, I want to thank you for taking your time to be with us today, and I'll let you take it away.
Awesome. Thanks a lot, Brian. Good afternoon, everyone. I appreciate your time. Hope everyone can hear me okay. I'm not sure where everyone's located. I'm actually here in lovely Omaha, Nebraska, so we're Happy Springs here. So if I sound happy today, that's why. First off, thanks, Brian and Premier, for letting me do this. Premier is a great partner of ours, and any opportunity I can take to talk to them and their team, I take very serious. So hopefully you find some value in this. If you don't, I apologize in advance, but hopefully I think you'll see some value in this talk. I am with MetLife Investors. I'm a wholesaler, been with MetLife for 6 years now. Previous to that, I was with another insurance carrier for 17 years. While I've never been on your side of the table, I've never been a life producer or an insurance producer for that matter. I have worked in every product line. I've wholesaled life, annuity, disability, long-term care, med sup. I've worked in banks, broker-dealers, retail. So I've sat in a lot of meetings with clients, with advisors, so I kind of get an appreciation for what you do, so I truly do appreciate that. And my point here is to give you a couple sales ideas I think you can use in your everyday practice that will lend value. So I'm not going to talk about life insurance as an asset class. If you look at the screen, you'll see that piece there. The topic of the conversation is short-term duration pay life insurance. 10 pay, 20 pay, things like that. But I wanted to show this piece only because I think it kind of gives the landscape we're in. And before I go into the landscape, let's talk about these short-term pay products and why they're there and why they're gaining in popularity. In our industry, they are gaining in popularity. Why? Well, at least the advisors I've worked with and the clients I've worked with for those advisors, folks currently, they want to limit their out-of-pocket expenses during their retirement years. And everyone says that, but when you know someone who's in retirement and you see what they're going through, I love the phrase, well, they're on a fixed income. Everybody's on a fixed income. Some of them are just fixed to a larger number. But everybody's fixed, and they want to mitigate their expenses when they get into retirement. So if you can show them a way to say, here's your insurance premiums, and we're going to be done in a defined time, guaranteed, that tends to pique their interest. Now, you can illustrate all pay scenarios for life insurance in a short-term duration. What do I mean by that? Well, I can show, and I have a UL product. I own UL, and I sell UL. And you can illustrate those to say, we'll only pay for a certain amount of years. And sometimes those work, and sometimes those don't. And they don't work when there's a need to rely on an illustration interest rate or crediting rate, okay? But there are other products out there that you don't need that. And MetLife, while I work for the company, I love Snoopy, that's great. It's not to say we're the only insurance company out there, I know. My carriers, my boss doesn't like when I say that, but we're not the only insurance company out there. There's other insurance companies out there. And I'm going to go through just a couple of our products that you can do that with and show you how the concept works. And again, that concept works with multiple carriers. So again, why this idea? Because folks want to mitigate their out-of-pocket expense when they get in retirement. And two, if you look at the business owner sales, i.e. with split dollar or key man insurance, they can be used to leverage company-paid premiums for incentives to attract and reward employees. And also, I've had some large scenarios where the business owner, they've bought the insurance on themselves. They're the key man. They're going to use business dollars to fund premiums that they can now use for themselves in retirement. And then lastly is, I would say the third reason why we're really seeing popularity in this is the environment in which we currently live. Now, some people, they're leery of the economy long term, and they say, hey, if I can lessen that horizon of relying on these level premiums that may not be so level in later years, maybe I'm thinking 7% is going to be good, for the long haul, and then it's not. I remember running ledgers back in the 90s on a sales desk where we were running ULs for 12 and 15%. Now, I know most advisors should and do advise their clients, when you look at a ledger, look at the current side. Now, this assumes these rates never change, and they're going to change. The problem is most clients don't pay attention to that. Well, they do, but 5, 10 years down the road, they change their mind, and they start to look at the other side of the ledger and think, well, guarantees are never going to occur. It's always going to be the current side, so it's always going to be 7 or 9 or 12%, and it's not. So some people, they understand that, and they go, listen, I don't want to look at that level premium for the next 50, 60, 70 years. I want to see what I can do short term. So now real quick, let's talk about the landscape. And as a couple, and I don't want to throw out a bunch of percentages, but I think these speak to the clients that are in our world today. Kiplinger did a survey with Thrivent Financial, and what they discovered was, of all of their clients with Thrivent Financial, 55% are now less willing to take risks with their money. Over half say we're no longer willing to take as much risk. But here's a big one. 60%, so 3 out of 5 of their clients, 3 out of 5, their number one financial goal is stability. Don't lose my money. Think about that for a second. 3/5 of their goal, of their clients, their number one financial goal, it's not earning 12%, and it's not, retiring at age 65, whatever it is. Their number one financial goal is to not lose their money. Whereas only 23%, just over a fifth, were hoping to actually increase their assets. That is a telltale sign of the environment we live in. Folks want to maintain their assets. If you can give me a little growth, great. But I don't expect the star on the moon anymore. So let's also talk about the sidelines. Everyone talks about, well, how much is on the sidelines? There's $9 trillion or $12 trillion on the sidelines waiting to be invested. What are they waiting for? We're waiting for the money to get off the sidelines and get into the game. And I would say the game has changed. I use this phrase, optimism coupled with ignorant bliss has left the building, and just like Elvis, they're not coming back. Why? Because the game is no longer about waiting for the S&P or the Dow or the Treasury. Everyone has something that they're concerned about. Currently, 401ks are at an all-time high. The market's at an all-time high. Unemployment is starting to go down. The housing market is trending back. I read an article 2 weeks ago that the housing market is now starting to get back to pre-housing market bubble levels. Yet, everyone is waiting. What are they waiting for? Well, I would say that everyone has a problem with something. And I don't know what it is. So, pick something. It's Afghanistan, it's Benghazi, it's Obamacare, it's the deficit, it's the debt ceiling, it's something. Everyone is worried about something. That's why doomsday preppers, I make the joke, but it's true. Doomsday preppers were the top shows last year. Why? Everyone thinks something bad is going to happen at some point. And the sidelines have become the playing field, thanks to the information access and the concern about anything. So if someone says, listen, we're at a reset of, I always say we're at a reset of logic, because people say, well, 12 to 15% is not going to happen again. What can people expect to return on their investment? Again, I'm not making these numbers up, but if I go back to that same survey and what Kiplinger put out, they said over the long haul, someone should expect to earn 7 to 8%. 7 to 8% during their working years. If you think about that, that's taxable. Now, I know I'm not Mr. Negative, Mr. Positive, but I would say I'm fairly middle of the road, and I think 9 to 10% is pretty good. But let's just take 7 or 8%. If that's taxable, what's your net? 5%, 6%, maybe? And that's where short pay life insurance products come into play. And that's why there's increasing interest in them, and why, if you look at whole life insurance, and I'll talk about whole life here, It's the #1 selling insurance product in the industry. Think about that. Whole life is the #1 selling life insurance product in the industry. Now, well, Index UL, that's pretty popular, but if you separate Index UL out from Universal Life and say it's a separate product, because I think it is, whole life is still #1. So now that I've said all that, let me look at this piece real fast that I put up here. These are life insurance as an asset class, and I think it gives a pretty good picture of a good concept and something that you can use with your clients. Now this is a piece, it's a client-approved piece. Let me just scroll down. It talks about why cash value life insurance, and that's what we're talking about, cash value life insurance. We're not talking about term insurance. You know, term insurance has its place. I love term insurance. I own term insurance, but it has its place. If you're talking about a short-term scenario, whether that be a whole life or index or VUL or UL, if you're talking a short-term pay scenario, you're talking about a cash sale, and a cash being an income type sale. So let's look at that. And one of the best tools you can use is this piece, because we talk about taxes. Why would someone want to do a cash value product right now? Well, because they believe taxes are going up. And if you look at that and you say, well, in that screen, over the last 100 years of taxes, look at our last 100 years of tax rates. And the single most important question you can ask your clients when you talk about cash value life insurance is, what do you think about the future of taxes? Or what do you think about the current state of taxes? Most clients, they would say, I hate taxes. Taxes are horrible. I hate the government. I hate Obama. I hated Bush before Obama. I hated all of them. I'm not going to defend how the government spends our money. I don't agree with that. But I would defend how much they actually take. Because over the last 100 years, when have tax rates actually been lower? But look at that. The top marginal tax rates have been higher most of the time. So if you take that and say, okay, based on that, Mr. and Mrs. Client, you're going to want to mitigate your tax risk, because at some point taxes are going to go up. Why would you want to put your money into a vehicle where it can be withdrawn tax-free? And that's why you look at 10-pay and 20-pay products. And that's why most people, when they look at the 10-pay and 20-pay products, they get sticker shock. Because by and large, they expect, term insurance, 20-year term for $100,000 a face amount cost me, I don't know, $50 a month, $100 a month, whatever it costs. That's what they think insurance costs. And when you show them a 10 or a 20-pay scenario, they go, whoa, that's expensive. Well, yeah, but are we worried about cost or value? What's the price compared to the cost or the value? And that's the difference. And that's what I'm going to show you. So now that I've said all of that, let me just say, again, many carriers offer short-term pay solutions. And we've got several of them. We've got several permanent products that I can illustrate to show short-term pay durations. I'm just going to show our whole life series. We've got multiple whole life products, but we've got a short-term pay duration. We do a 10-pay and a 20-pay, and then we have a pay to 65. And I can actually take that 10-pay and I can pay it shorter. I can pay it down to 5 years. But it doesn't work in reverse. Given the premium amounts and MEC limits, generally you cannot pay longer or higher amounts. So I can't take my 10-pay and overfund it. I can within limits, but I can't double it, or I can't pay that 10-pay for 15 years. So what do you need as an insurance advisor? An insurance advisor needs the exact same thing that I do, and that is a reason to talk to your customers. Brian doesn't appreciate when I show up at his office and just say, hey, what's new? I'm not going to waste his time. I need to bring a valuable idea. When you talk to your clients, you need an idea. And I think that's what this does, because you need something to address your clients, and you need to address something they want to hear about. And that's growth and preservation of their capital, and that's what this does. Because according to LIMRA, the #1 fear of your clients, the #1 fear is that they're going to outlive their assets. Think about that. You couple that, their #1 fear is outliving their assets, with what I said earlier, that almost 60% say don't lose my money. That's my #1 concern. So now that we've talked about that, let's look at some ledgers. The This is our 20 page. Let's go to the 10 page first. Let's talk about this. Okay, let's talk first how cash value works in a life insurance contract. Okay, how does cash value work? Well, some people, and if you don't fall in this group, I apologize. I don't want to speak down to the audience. But I've had some advisors not understand. They think it's taxable, it's not taxable, what part's taxable. Generally, and this is, I'm going to make some assumptions. I'm going to assuming this is a non-MEC contract. When you have cash, you first surrender your cash up to your basis in the contract. Anything up to your basis is non-taxable. So I put, in this scenario, I've got a ledger. I've got a, gentleman, he's going to take $25,000 a year for 10 years. That's 10 times 25 is $250,000. So his basis in the contract is $250,000. So I'm going to surrender up to $250,000, all non-taxable. After that, I'm going to take loans. Now, loans are not taxable, meaning everything I take out is non-taxable as long as three things occur. And generally, these do occur, but I always point them out. The policy stays active. Okay, you got to keep the policy active. You can't go on a reduced paid up status. So you can't say, well, there's a reduced paid up column over there. You can't do that. And you can't switch your dividend options to cash. Now, dividends to cash isn't always bad. That's a whole other conversation. But as long as you don't switch that dividend option, then everything is non-taxable. The only downside is your net death benefit, because that income is going to come out tax-free, and we're going to reduce the death benefit. So that, again, this is not a death benefit sale. This is a cash sale. If they're worried about having a higher death benefit, then it's supplemented with the term insurance, or it's supplemented with a UL contract that's stripped out of its cash. We have a UL to 95 contract. Hancock has a great product. Other carriers have great products that are cheap UL, guaranteed only for a death benefit. Those can supplement these cash contracts. The other thing I want to talk about is the ledger. There's three sides of the ledger that I always say please pay attention to. The guaranteed side on the left. Now, guaranteed implies your worst case scenario, and every carrier is different. So for us, well, I should say we're all the same. We have the guaranteed, but for us, what does that mean? So this is a participating whole life contract. That means that we're participating, the policyholder is participating, and we're paying them dividends. Guaranteed implies that we're paying no dividends whatsoever. Now, we've paid dividends literally for 140 years. But this side of the ledger means that Mr. Policyholder, Mr. Preferred Non-Smoker, 40-year-old, you bought this contract today, and starting tomorrow, we, for the first time, have stopped paying dividends, and we're never going to pay another dividend. That's the guaranteed side. Now, I know that's not going to happen because we're paying dividends tomorrow. But I point that out because, especially with UL type contracts, again, I own one, and I've experienced it, and I own a VUL, and I've experienced it. Over the next 15 to 45 years, what's going to happen? The contract's going to go up and it's going to go down. I think our dividends are going to go up, but you know what? They also could go down, and that happens over 45 years. They're never going to stay the same. So I always tell folks, look at the guaranteed side. That's your worst case scenario. Sell to the guaranteed side. If they will buy a contract based on the guaranteed side of the ledger, they shouldn't buy the contract because they need to know what could possibly happen. The other side on the right is the non-guaranteed, which is our current side. That means at our current dividend rates, currently our dividends are lower than they've ever been. So if you look at the dividend rates, 5.1, currently the lowest we've ever had. Now, we could go up or we could go down. But based on current rates, that's what you're going to get. Now, I'm an optimist. I think they're going to go up because they've never been lower. But currently, that's the lowest. And that's where we are currently. So, two sides. The last side is the cash. And I'll show you the cash report in a second. Why do I show the cash? That's why they bought the contract. You don't buy a whole life just to leave the cash in it. Susie Ormond, I'm not a big Susie Ormond fan. She says don't buy whole life, don't buy UL, don't buy cash contracts, buy cheap term and invest the difference. Why does she say that? Well, she says that because number one, I I'll skip number 1. I'm not a Susie Ormond fan. But here's the reality. She says it's a bad investment. 98% of term policies don't pay a death benefit. So in my mind, she's saying she'd rather you have a 98% chance of zero return, only for a death benefit, which won't pay out. But she also points out, and this is true, in whole life contracts, if you buy a whole life contract and you die, the greedy insurance company keeps the cash. Guess what? She's right. We do. If you die, you don't get the death benefit and the cash. That's why you should take the cash out. We'll pay you the death benefit, but take the cash out. Folks need to see the cash income stream on any contract that has cash in it and be prepared to take that out. That's why they bought the product. If they weren't planning on taking the cash out and leaving it in, they should have bought a term contract or stripped out UL. So now that I've said all that, let's look at the ledger. This ledger, you take $25,000. Now, I can solve this ledger multiple ways. I can run this product for an income stream, an income solve, a death benefit solve, whatever. Short-term pay duration, long-term pay duration, whatever. On this one, it's $25,000 for 10 years. Now, the first thing that jumps out at me, because I've been running ledgers for 20-some years, is the death benefit. It's only initially $700,000. That's a small death benefit for that premium and that age. Again, why? It's not a death benefit sale. Yeah, fundamentally, we're selling life insurance, so there's death benefit involved, but they need to understand why they're paying that much for that much of a death benefit, okay? It's the cash. Look at the cash. On the guaranteed side of the ledger, in year 10, they've paid $250,000 total. By year 11, what's their total cash? It's almost $250,000. That means at zero dividends, you still have all your cash sitting there to take out. Now, on the right side of the ledger, on the current side of the ledger, if I show over here, by year 11, after paying $250,000, you've got $290,000 in cash. So you've got $40,000 more. And on the far right, you see your death benefit starting to grow, because we start off at 706, but when you put that much cash into the contract, it starts to grow exponentially here in a second. Look at the cash value growth right here on this column on the guaranteed side, I'm sorry, on the current side of the ledger. Your contract is paying $25,000 a year in premium. By year 4, at the current dividend rates, which again are historically our lowest rates, you're getting $28,000 in dividends. By year 5, 30. By year 10, almost 40. Now year 11, it drops. Why? There's no more cash going into the contract. But let's scroll down and look what happens. When you start to get down here, again, it picks up 15, 16. By age 60, you're getting 25 grand a year in dividends, and you haven't paid a dividend in 10 years. So scroll down. Let's go down here to age 70. Age 70, let's see here. There we go. Okay. Can everybody still see that? I want to make sure I had to move something so I could see it. At age 70, even on the guaranteed side, no dividends, you got $430,000 of cash. That's $180,000 more than you paid in. On the current side, you got $817,000 of cash. Again, low dividend rates, $800,000 of cash. That's why you buy cash value life insurance. Scroll down to the income stream, and now I always say include the cash report to show what it looks like. I cannot call this my return of premium product. My compliance department told me that. But I can't call it my return of premiums paid in concept. So I call it my ROPIC. Okay, you pay 25 grand a year to age 50, then you stop. At age 65, we're going to take $250,000 out. Now I solve for my maximum income stream. So you're taking $250,000 out. Mr. Policyholder, you've taken all your premiums back. And you now have an income stream of 25, call it 24.5, almost $25,000 a year, tax-free for the next 20 years. So between the ages of 66 and 85, your retirement years, we're going to give you, I'm going to round up, call it 25 grand a year, above and beyond any premiums you paid in. We gave you back your $250. Now you're going to take back $24,499 for the next 20 years. tax-free. Tax-free. That's a pretty good income stream. Now, what's the downside? Look at the death benefit. Your net death benefit drops down to $433. Why? Because we're not paying taxes on that income. But hasn't their death benefit need likely decreased? I would say yeah. But at the same time, they should have supplemented this policy with other term insurance or UL insurance to get their death benefit needs up. The thing I like about this product, and again, I own UL, but the thing I like about this whole life contract is when you have a UL contract and you start to take cash out, what generally happens? Well, if I stop paying premiums for 20 years and I take money out of it, it becomes a race. What's going to happen first? Am I going to die first, or is the contract going to die first? With whole life, it's different, because look at your gross cash value. I'm sorry, your net cash value. I've taken all this money out. By year 46 at age 86, I'm at $216,000 of cash, and it continues to grow. I haven't paid premiums at this point in this contract for 40 years, and it's still growing because it's a dividend contract. Now, let me add another ledger to it. Let's look at the 20 pay. Same concept. I'm going to pay for 20 years. Okay, $250,000, I'm sorry, $25,000 for 20 years. So my basis in the contract is $500,000. Why did I pay 20 years? Well, ages 51 to 60 are better earning years than ages 41 to 50, statistics show. So sure, I'll keep paying for another 10 years. My cash on the guaranteed side is $518, more than I paid in. Worst case scenario, take your money back. On the current side, it's called $750,000 when I'm done paying. So let's fast forward. Let's go 65, 70, which are more likely retirement ages. At age 70, on the current side, I have $1.3 million of cash. 5.1 dividend rates, $1.3 million of cash. I go down to the income stream, and on the income stream, I'm going to say, okay, take back your $500,000 that you put into the contract at age 65, and now you get $44,000 and change for the next 20 years. So almost 900 grand above and beyond what you paid into the contract over 20 years, income tax free. Why? Well, because you overpaid for a contract for 20 years. Now, I'm being facetious. You didn't overpay for it, but you overfunded a contract. And because you did that, you can take all your money back and get income tax free income stream of 44 grand a year for 20 years. Now, what's the downside? Okay, your net death benefit. Net death benefit drops. But again, what's the need? Now, lastly, let me point this out. Not everybody works with clients who are 40 years old and have $25,000 a year to invest. I get that. I'm choosing a large premium number for the sake of this illustration. But what if you say, well, this doesn't work for me, I don't have those clients. Okay, let's take this guy. He's 35 years old. He says, I can get $500 a month. I can put $500 a month into a contract. Now, the large whole life companies out there, the career-driven companies, do a great job with this, whether it be Northwestern, Mass, Mutual, Guardian, New York Life. They do a great idea with the same concept. They say, hey, what can you afford to set aside each month? You're 35 years old, you've got a family, you're starting to earn some income, your best earning years are in front of you. Well, I can put $500 a month aside. Great. Here's what it looks like. We're going to put $500 a month aside into a contract until your earning years are complete at age 65. That's $6,000 a year. Now, your net death benefit initially is first $356. So it's low. So we're going to have to supplement that with some term insurance. Buy some cheap 20-year term while you're in your earning years. Okay? And you pay $6,000 a year for the next 30 years. Now you're done at age 65. At age 65, you're done. Your basis is 180 grand. You put 180 grand in this contract. You got 191 in cash on the current side and 191 guaranteed, 338 on the current side. Let's go to age 70. You've got $442,000 of cash on the current side that you can take out. So let's look at the income stream. Okay, I said instead of saying take back all your premium, because this guy just wants an income stream to supplement retirement, how much can we take out for retirement? Between the ages of 70 because most people, and again, why did I choose 70 instead of 65 or 66 for this one? This is what I call the realistic guy that most people work with. He can afford $500 a month, and he's going to work till age 70 anyway. That's when he's going to, by the time he gets to 70, that's going to be realistic. So at age 70, we're going to take out $27,387 tax-free. $27,387 for the next 20 years, tax-free. For setting aside $500 a month, you get 27 grand tax-free. What is that? You know, if you put that in a taxable asset at 30% taxes, what do you get? You know, 35, 40 grand a year that you need to make in order to walk away with 27.3. That's a realistic sale that most people are buying. Our sales for MetLife have dramatically increased in the last 3 years on whole life. And I've had very large sales on this scenario, meaning the short-term scenario. I had a sale, a very large sale. It was a business entity, 6 owners, wanted to do a buy-sell arrangement. They bought a 10-pay for those purposes, and they walked away, the advisor walked away with a multi-million-dollar premium because they said, hey, pay it for 10 years and be done with it. If you take that to a business owner sale, it's amazing. But if you don't work in the business market, how many of us work with this guy right here? He's 35. He can put $500 a month away. He's going to get, you know, his death benefit, a good portion of it met right there, and he's going to have 27 grand a year in income tax-free income when he retires. So that's the gist of it. That's the gist of the select products. Again, MetLife, I think, does an amazing job, and I'm not saying that because I work for them with their products, but other carriers do as well. Other carriers have these short-term pay products, and that's why you're seeing the interest in them. Let me go back to what I started with. If you look at statistics, most people are worried about the future. They want to mitigate their risks. They want to say, show me something. I don't expect 10 or 12% anymore, particularly my insurance products. If you show me a way to at least protect my assets, that's what this does. If you run the internal rate of return on these, you're showing 4 or 5% internal rate of return. If you show that to someone, guaranteed, tax-free, that's a pretty good deal. So again, we're not the only ones that do it. A lot of great carriers do it. The thing I love about Brian, I love about Premier, is they don't just represent MetLife. They represent the best carriers in the business. And whenever you talk to them and you say, hey, here's my scenario, they bring the best carriers. And it's probably not MetLife. You know, we fit a small percentage of their business just as all those carriers do. And they can match you up with the best carrier for the best scenario. So that's what I had to talk about. Are there any questions? Brian, did I cover anything else you want me to address?
If there's any questions, if you want to use the chat feature to ask a question, just type that in now. And we'll give them a second or two, Mike. Appreciate you taking your time. Some great stuff. Did a great job. And based on what I'm seeing here, we're getting a lot of people jumping off. So let's sign off. Thank you, everyone, for attending. Thank you again, Mike, for presenting. It was great information. If you have any questions, give us a call at 800-365-8208. Just ask for a Life Marketer. Thank you.
Thank you.